You've seen the headlines. Five-star funds to watch in 2023. This top-performing fund is shooting out the lights. 10 mutual funds poised to outperform. The Financial Pornography Network is obsessed with investment selection. More than the general rise and fall of the market or economic forecasts of the future, they love to write about specific companies or funds and prognosticate their potential. Because financial journalism cares so much about investment selection, so do we. Investment selection is the specific companies, debts, or funds we invest in. We talk a lot about broader financial planning and principles of investing in retirement. Those principles are great and inform how we should invest. But at the end of the day, we need to select a definitive investment or set of investments with ticker symbols to invest our hard-earned cash. How should we select our investments? The media's focus on it may lead us to believe it is critical to select our investments immediately. They encourage us to select popular funds, highly rated funds, or whatever else they erroneously think will outperform in the future. Let's set the record straight. Last week, we looked at where investment selection fits in the financial planning process. If you missed that, pause this and listen to that first. Then come back to investment selection. First, we'll examine how not to choose your investments. Like many things we do on this podcast, often it's more about what we don't do than what we actually do. We'll then wrap up by exploring the principles for choosing investments. We'll never tell you where to invest on a podcast because we can't and won't give investment advice to the general public. But educational principles are always helpful. So first, investment selection the wrong way. Here are 3 bad ways to select investments. There are many more bad ways you could do it, but here are at least 3 that we're going to cover in this episode. The first is investment selection by past performance. Far too many people choose their funds based on past fund performance, specifically recent performance. It's mind-numbing just how dumb this idea is. Let me tell you a story to illustrate this point. The perfect investment. It was the last decade. The time frame was the years 2000 through 2009. The stock market and nearly all equity funds were generally flat or down in value over this 10-year stretch. Now, just as a quick side note, it's pretty easy to find extended periods of loss when you measure from the top of an inflated bubble to the bottom of a subsequent crash. But I digress. I say nearly all equity funds were down, but not all. One fund in particular did quite well. From 2000 through 2009, CGM funds, Focus Fund, returned a whopping 18.2% per year. 18.2% per year. If you had invested in the fund in 2000 and stayed invested throughout, you would have more than sextupled your money in 10 years, during which the S&P 500 had lost money. It was a staggering achievement. This story has 2 morals. The first of which, I will introduce now. Right, that during that period, when the investment fund, right, the actual fund itself, had averaged 18.2% per year, the average investor in that fund averaged minus 11% per year. You heard that right. Not 11% per year, as in they performed 7% less than the fund, negative 11%. The fund did 18%, they did negative 11, a 29% difference. The asset allocation was 100% equities. The fees were irrelevant based on, due to its vastly superior return. Almost everything else was negative, right? And the next closest competitor averaged only 14.8%, which would have only quadrupled your money over that time. This was the perfect investment selection for the time. You could not have picked anything even remotely close to this investment for that period. But the behavior of most investors was utterly flawed. They jumped in after the fund had grown, investing based on past performance, and jumped out after the fund went back down, assuming that the potential performance would continue to fall. The first moral of the story is this: it doesn't matter how perfect your investment selection is if your investment behavior fails. Let me say that again. It doesn't matter how perfect your investment selection is if your investment behavior fails. We got to stop focusing so much on investment selection and focus more on investment behavior. We are better off selecting and sticking to investments that are suboptimal in retrospect than trying to pick the best performing funds and continually botching the timing. For a decade, the CGM Focus Fund was the best performing fund in the market, and it wasn't even close. We're not talking about a one-hit wonder that it was a top performing fund for a year or two. The Focus Fund reigned supreme for a decade, which many people would consider long-term. Isn't that enough past performance to indicate future return? Isn't that enough data to select and stick to the fund for good? CGM Funds is now defunct. That's right. In November of 2022, CGM Funds, the manager behind the best performing fund of the last decade, closed its doors. The vaunted Focus Fund is no more. And here's the second moral of the story, right? Past performance is no guarantee of future returns. We say that, right? But I don't think it always sinks in with us. A fund will not necessarily do well in the future just because it did well in the past. Even the very best funds over a certain period can die over the next. There is no evidence for the persistence of performance. When you select your investments, do not base it solely on a fund's past performance. It may not mean squat. The next issue that people have, the next wrong way to invest, is to do your investment selection by potential performance, right? You can't base it on past performance, but you also shouldn't base it on potential performance. Past performance is easy to look at. It's published everywhere. But what about future performance? Is there any way to determine that? No, of course not. There's no way to tell if an investment will do well in the future. That doesn't stop the financial pornography network or investment managers from trying to do that. The former will whip out 1,000 articles a day telling you what may be the next Amazon or Apple, and the latter will have grown quite adept at selling investment theories. But even if you find a chief investment strategy keen on one fund or sector, you'll find another with evidence for the opposite. Most fund managers underperform their indexes over a given period. Most funds that overperform one year go on to underperform the year after. There's no way to know which one will be the best in the future, and anyone who tells you otherwise is selling something. And the last wrong way to invest is investment selection by star rating. A popular way to select funds is based on their star rating. There's this company, it's a rating company called Morningstar, and it produces a star rating for most funds available, and they rate it anywhere from 1 star at the lowest to 5 stars at the best. And most people, or many people I will say, will select their funds based on their star ratings. And star ratings are calculated based on a risk-adjusted past performance. So what does risk-adjusted means, right? Well, generally, it's the volatility of a fund went through to achieve that return. Right, so an equity fund, owning good businesses with a 10% rate of return may receive 4 stars, while a bond fund with a 4% rate of return may receive 5. Even though the equity fund had better performance, it had more volatility to get there. This makes some sense to an extent, right? Because otherwise, all equity funds would mostly be 4 and 5 stars, and fixed income would be mostly 1 to 3, right? You can't compare apples to oranges, and so they need to adjust that return based on the risk to get some kind of even way to, assess these different funds. But it doesn't tell the whole story. As discussed in episodes 13 and 52 and others, volatility is not a problem. It's the price we pay for superior returns. The S&P 500 fund may be 5 stars with a 10% rate of return. And a small cap fund may be 3 stars with a 12% rate of return over the same period. If you only select based on the star ratings, you may be missing out on its superior long-term performance in an attempt to reduce your volatility. And so we can't just base it on our risk-adjusted returns. We want, in general, right, to look at total returns over our lifetime. And what's more, the past has different lengths, right? Morningstar issues star ratings for funds that have been around for at least 3 years, right? So they won't do it for a brand new fund. It has to have been around for at least 3 years. And obviously, those funds have been around for a lot longer. And so it has a weighting system for the length of history. And it more heavily weights a fund's 10-year return over its 5 or its 3-year return. But there's a big difference between a 3-year histories and 10-year histories. A fund that has only been around for 3 years can be rated 5 stars. And a fund that is 10 plus years old may only get 4 stars. If the fund, is this 5-star fund that's only 3 years old better than the 10-year-old fund with 4 stars? Who knows? It's only been around for 3 years. It hasn't had time to do poorly yet. You can't compare funds with different lengths, even if Morningstar says you can. And lastly, past performance is no guarantee, right? Perhaps you caught it when we first brought up how star ratings are calculated. Again, they are applied based on a risk-adjusted past performance. And what does that mean as far as future performance? Squat! Just because a fund performed well in the past doesn't mean it will in the future. There's this concept called regression to the mean. It essentially states that when you have volatile numbers, they will return to their long-term averages. So for example, equities average 10% over decades. If a fund has recently outperformed that average, it will likely move into a period of underperformance to return to that long-term average. People who move their money into 5-star funds are buying funds that are just as likely to underperform going forward as they are to continue their great returns. Right? If it's temporarily over the short term done well, done above the average, then it's likely to go below the average going forward. And if you keep moving your money into those 5-star funds with recent good performance, you are probably buying at the top. If you find yourself in funds that are 5 stars, it doesn't mean that you should get out of them. It just means that you shouldn't continue to move your money into 5-star funds when you see that your current selection has lost a star or two. It's called chasing returns and is the first of the 4 horsemen that we've covered in episodes 55 and 56 and elsewhere. You don't select your investments based on star ratings. That's the same thing as selecting your investments based on past performance. If we shouldn't select based on past performance, potential performance, or star rating, how should we choose them? So how do we do investment selection the right way? So I'll set the stage. You have a goal and a plan to get there. You're building your portfolio and have determined your asset allocation and diversification. You're selecting lower fees when possible. And so beyond all that, what do we choose? Well, 2 caveats before we continue, right? First, this is not investment advice. I do that one-on-one with clients, not one-to-many via podcast. Second, there are 1,000 wrong ways to select investments and a few good ones. I subscribe to and teach one of the good ones. There are other strategies out there, and proponents of those strategies would agree that there are a few good strategies at the top. As long as you're in one of those, 6 of one is worth half dozen of the other. So I subscribe to index investing. We could do another podcast on active versus passive investing, but I don't teach, as some passive advocates do, that you should put all your money in Vanguard's total market fund or into a target date fund. There are better strategies than a total market fund, and target date funds are awful. Right? We've covered that in previous episodes, episode 23, I believe. No one should be in target date funds. The beauty of index investing, though, is that they self-select for success. While a single company may die, if you remember Circuit City, an index of them won't. Right? A dying company will simply fall out of an index. And while past performance won't guarantee future returns in a fund, aka the focus fund that we've been talking about, past performance of the best businesses in the world appear to continue. My portfolios are constructed of multiple index funds that follow indexes that have been around for decades. Not new indexes just created to follow some hot trend, but indexes that have been around for 30 years or more and have a track record of persistence. Long-term performances of all these indexes is double digits. Those indexes rise and fall, sometimes together and sometimes separately, and the strategy creates opportunities to rebalance, selling a little bit high and a little bit low. The fund's star ratings change as the performance ebbs and flows, but we don't deviate. It allows us to capture a greater breadth of companies than just the S&P 500 or a total stock market fund. My personal investments are invested in the same way as my clients. If there's a better way to invest for my children and legacy, I would do it, but there isn't. Again, I can't tell you what funds those are. That's too close to investment advice. And I'm not going to say that you should even do this for the same reason. But a principled and disciplined approach to long-term investing is the only way to find long-term success. Your behavior and asset allocation matter more than investment selection by orders of magnitude. If you enjoyed that, you would love being part of our free membership community. It's called Retire Membership and it has a host of benefits all for free. For example, you can always buy my book, 3D Retirement Income, on Amazon. But if you join us at Retire Membership, we will send you either a hard copy or paperback for free, provide the ebook and the audiobook so that you can listen to it if you don't have time to read it. In addition to that, we'll also provide you with a bunch of content that you can't get anywhere else. For example, we have our quarterly Retire Mentorship magazine, which comes out quarterly and has no ads whatsoever. It's just timely content to help you stay the course. We also have workbooks for our free online workshop to help you get the most out of those, flowcharts to help you make better decisions, and a weekly email to provide timely content that you can unsubscribe from at any time. We never ask for any payment information, and we never share your information with anyone else. We just want to provide timely content and help you stay the course to retire successfully and stay successfully retired. There's no reason to wait, so join us now at retiremembership.com, where you can click in the link in the description and it'll go right there. We can't wait to see you in the community. Cheers. This podcast is educational only and is not investment, tax, or legal advice.